Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to share with you 10 different companies that seem undervalued at the moment. But before we get to that, just to kind of give you overview of where we are. If you haven't seen my last video, go and watch that one first. The Silicon Valley Bank situation still continues, okay? It looks like maybe next week we'll get more information of exactly what happened and some of the companies that basically been affected by this situation right now. But it's very annoying to see this kind of articles, because how is it possible the employees of this company actually received the bonuses hours before it closed? And the UK is now trying to find out exactly, basically helping different, basically the UK based companies to minimize the damage. And apparently there's so many different companies. So I think next week what we will see more of is exactly what companies have been impacted on this situation, basically the companies that have been affected, if you like. So companies like Roku, for example, because remember, all these companies had the Silicon Valley companies, the startup, new companies, IPOs and so on. They've had a lot of money basically deposited into the accounts of this company. And now the company is almost gone. So they're losing their money. So Roblox is one of those. Roku is another company. Etsy apparently is part of it. BlockFi. So you'll probably see a lot more of that news next week. And so we'll see what happens, but it doesn't look that great. So it might impact again the overall markets. So if we get an opportunity to buy great companies at a discounted prices, that's exactly what we like. So I'm going to quickly go over. I don't want to I'm going to give you the basic information of these companies. So if you're really interested, you're going to have to go away and do a little bit more research each one of these companies. So the first company is Pfizer. Pfizer has been kind of going downhill, not downhill, but basically been down quite a bit in the last few weeks. And the reason is because the company, when it comes to the growth estimate for the next 5 years, basically, it looks like it's going to come down a bit. Because remember, the COVID vaccine actually did help this company, as basically it's gone up quite a lot in terms of revenue, in terms of they've made so much money, so much profit from the selling the COVID vaccine, and now they have to basically they're coming back down. So their prices right now less than $40, and I think it hasn't been this much since I sold it. I think I sold it when it was almost to 50, and then when I actually bought it was about 30 something, 37 whatever, and then I sold it when it got to 50, and now it's back down again. It seems a little bit interesting. If you're that type of person that's willing to wait for another 4 or 5 years, then you obviously have a great company, because when you look at the financials, it looks really good. So the dividend yield is about 4%. The latest increase was only 2.5, 5-year growth rate of 5%, but payout only 24%. They have increased the dividend for 24 years. They have $1.64 of annual payout. Safety is 75%, which is really good. Profit margin return on equity is really good. But they have $26 billion of free cash flow, which is really good, and 7% return in the last 10 years. So this year they expected to grow the earnings about 11%, but after that there is some sort of a decline happening, maybe 5%, 4%, whatever it is. Morningstar is saying right now is 18% undervalued. $48 per share is where the price should be. The next company we're looking at is Lind, or Linda, whatever it's called, is a what do they do again? Yeah, industrial gases again. So it's very similar to air products and chemicals. They're in the same industry. It's bigger than the air products and chemicals. I think air products and chemicals is about 60 something billion dollar market cap. This one is 178 billion market cap. It has a narrow economic moat, $341 per share. Dividend is quite low, 1.5. Let's call it. Latest increase was 5%. 5-year growth rate of 8%, payout ratio 38%, which is really good. Okay, but they have increased this dividend for 30 years in a row. The annual payout is $5.10, which is quite nice. 99% safety, profit margin of 12%, return on equity 10%, free cash flow of almost $6 billion, and they have returned 13% in the last 10 years. Next year they're expecting 10% growth, and then following 5 years about 10% growth. This is really good for this type of business, okay? And only though with 5% discounted right now, $359 per share is where the price should be. So again, another one that's undervalued. It's a really solid business. They're growing their dividends, they're growing their top line and bottom line and so on, and they are expected to grow their earnings in the next basically 5 years at least. Medtronic is another company that I own in my portfolio. I've talked about the company so many times before. It seems 32% discounted right now, and the dividends is really solid. They have increased it for 44 years. They pay you $2.72. and they have $4 billion of market cap. Free cash flow, sorry. The market cap is $111 billion, and it has a wide economic moat. So it's a great company. I own in my portfolio. Basically, their products is actually used in almost in every single hospital. There's still demand for it. So basically it's down because of the overall market is down. And I think one of the 2 quarters, I think past quarters, it was actually down because they actually missed one of the revenues. I can't remember which one it was. And then from there onwards, they have been trading about in the 70s and 80s, and I've been buying a lot. I'll show you how many shares of that company that I own in my portfolio. And then the next one is Albemarle Corporations, and this company basically sells specialty chemicals worldwide. And it's one of the companies actually when COVID happened, it's gone up so much, but it came back down again. It's basically 30 billion market cap. It has now economic mode, $225 per share. Less than 1% dividend yield. Latest increase was 1%. 5-year growth rate. Payout ratio. When it comes to the dividend, to be honest with you, you wouldn't own this company for the dividend. You would own it because look at this. This year they're expecting 1% growth, and then after that 95%. I don't know if these analysts, the Yahoo Finance analysts, basically are being realistic, but 95% every single year for the next 5 years. That's absolutely amazing. The company is down right now 36%. If you own it, let me know if you think that's the truth, or like even if you have done some analysis on this company, you know probably a lot more than I am right now. But in terms of free cash flow, it doesn't actually have that much, okay, of a free cash flow, but it definitely covers the dividends because the payout ratio is only 7%. Okay, they have increased the dividend apparently 28 years in a row, which is really quite good. Right, so yeah, another great company there. The next one is Intuit. This is one of the companies that provides financial management and compliance products and services for consumers. They work with a lot of the small business companies. There's a software called QuickBooks Online. That's basically one of the things they own. They also have a cloud-based solutions, QuickBooks Enterprise, and so on. Currently, they're trading $392 per share. Market cap is $115 billion market cap, which is quite good, and it has wide economic moat. Dividend is actually not that great, okay, but they have increased it 15% each, basically last year, and the last 5 years on average 15%, which is really good. Payout ratio is very low, and they have increased it for 10 years. So actually, this is not bad at all. But considering they pay you $3.12 as well, which is quite nice. And in terms of profit margins on return on equity, is actually good. Free cash flow of $4 billion and total return 21% basically in the last 10 years, 13% and basically next year in terms of earnings growth, and then growth estimated for the next 5 years is actually 15%. 22% discounted right now, and $503 per share is where basically it should be according to Morningstar, which is really, really good for a business that's growing their dividends. Okay, what you will then need to do is basically find out a bit more information about the company, who their customers are, and if the company, basically things like QuickBooks Online and so on, if it's actually one of those like a sticky businesses, or if they can be replaced and so on, although it has a wide economic mode, which is quite good. So if you're interested in this company, you will be, you go away and do your little bit more research. I like the dividends. I like how the company, the type of business they have, and the fact that they actually got $4 billion of cash flow, which is really good. Next one is Lamp Research Corporation. This company deals with the semiconductor processing equipment. Currently has a 66 billion market cap, wide economic mode, $478 per share. It has 1.4% dividend yield. Latest increase was 15%. 5-year growth rate of 29%, 17% payout ratio, 8 years of increasing that dividend. And you get $6.90 of basically for your own shares of this company. Safety 66%, so it's slightly low. 61 and above is fine, but it's still a little bit low here. Profit margin 26%, let's call it 27%, and return on equity 73. 2.9 billion, let's call it about $3 billion of free cash flow. Total return in the last 10 years 28%. Next year minus 20% growth, and then 2% after that. So for that reason, I think the stock's down quite a bit. And generally the whole semiconductor companies are down this year anyway. 23% discounted right now. 620 is where the price should be. I'm going to show you guys in a second the Sharia compliance side of things as well. If you haven't liked the video, please do so. If you have not joined us on the Patreon and the Discord accounts, please do so as well. It really helps the channel. Now the next one is Electronic Arts Inc. This company, I'm sure you know if you ever played any of the games they own. My kids love their games. Obviously every year we buy those games and it costs us a lot of money, I'll be honest with you, right? $31 billion market cap. It has a narrow economic mode. Price is $109 per share right now. Dividend yield, we're looking about 0.7. Latest increase was 12%. 5-year growth rate is non-applicable because they started very recently. Okay, they've only paid for 1 year. Payout ratio 13%, which is nice. Annual dividend is 0.76 cents, sorry, and then 80% safety, which is nice. 14% in terms of profit margin. Return on equity about 14% as well. Free cash flow $1.16 billion, and total return in the last 10 years was 20%. 9% growth expected next year, and then 3% after that as well. 23% discounted right now. $142 per share is where the price should be. The next company is Robo Technologies. This company again sells a lot of software to industrial companies. It has 45 billion market cap, wide economic mode, $420 per share right now. Dividend is quite small. The payout latest was actually increase was nice. The 5-year growth rate is 12% and 17% payout ratio. Dividend streaks of 30 years, so they are dividend aristocrat. $2.73 for owning each basically a share of this company. Safety right now is 98%, which is really good. Profit margin and return on equity is really good. They have 664 million free cash flow. Again, because it's a small cap company, it's not about 43. It would have been nice if it's at least 2 billion, whatever, but that still covers because the payout ratio is only 17%, and they do actually have been increasing that dividend for quite some time as well. Total return, we're looking at about 13%. When I talk about free cash flow, guys, free cash flow is really important to us because that's the money the company uses to pay us over, obviously, the dividends, buy back their own shares, pay off any debt the company has, and acquire other businesses and so on. So they can use a lot of that. So just 664 million is not that much, okay? So that's why I would be a bit hesitant to own a company like this. But I do own Air Product and Chemicals, which has maybe about half of that. So, and as long as they covers the dividend and they can, obviously the revenue is growing, they can hopefully take some of that money from the revenue and put it into the bottom line, which is the net income, if you like. Right, in terms of next year, 7% growth and then 9% after that. 21% discounted right now. $530 per share is where the price should be. Next one is Skyworks Solutions. Again, another company that's in the semiconductors basically companies. $18 billion market cap right now. It has a narrow economic mode, $111 per share. Dividend is actually 2%, which is quite nice. Latest increase with 11%, 5-year growth rate of 15%. This actually seems interesting in terms from dividend perspective. Payout ratio is low. 8 years of increasing, $2.48 for every share of this company you own. 68% dividend safety, 22% profit margin. Return on equity is also the same. 1.14 billion free cash flow, almost 20% total return in the last 10 years. 15% expected to grow the earnings about 15%, and the same goes for the next 5 years. 28% discounted right now. $155 per share is where the price should be. And finally, Estee Lauder is another company. This company owns every single makeup company out there, so they are like a holding company, if you like. 64 billion market cap. It has wide economic mode, $236 per share. 1% dividend yield. Latest increase was 10%. 5-year growth rate of 12%. Payout ratio is slightly high, 47%. I think this is probably the highest in this list apart from Medtronic here. Okay, 47%. 2 years of increase in that dividend. $2.64 is what you will get. Safety is 70%, which is absolutely fine. Profit margin is very low, but return on equity is really good. Almost $1 billion of free cash flow. Return on equity, basically total return in the last 10 years, we're looking at about 14%. Okay, in terms of next year, they're expecting the earnings to grow 47%. That's crazy. Right, 47% expected for the next year, and then 7% after that, which is, if that happens, even if half of that happens, right, even if you get like 23%, that's huge. That's like what the technology like Teslas and so on are basically going for. But 13% discount right now, $273 per share is where the price should be. I'm going to quickly show you. You can pause the video and have a look at it in terms of Sharia compliance side of things, business side of it. Everything looks good. Out in terms of interest-bearing debt, the one that I will be worried more about is Skyworks Solutions, and obviously Medtronic is about 23. Anything about 25, I don't want to touch it these days, but 23 is absolutely fine. And when it comes to interest-bearing securities, according to Zoya, it's absolutely fine as well. There you have it, 10 different companies, all in different sectors and so on. That could potentially be a good addition to your portfolios. Again, majority of these companies, apart from Linda, all of them are down about 23 or maybe 10%, 13%, 20, 20, 20, 20, and then there we go. So you've got really wide ranges of companies out there. You can actually look into a bit more details, inshallah. I don't think the markets are going to recover this week coming. I genuinely, because of all the sentiment, like there's a negative sentiments out there right now. But we'll see what happens. These markets have been absolutely mad, so it might actually surprise us all. I hope you're enjoying the videos. If you are, please like, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.